Good morning, one and all. I'm Bhuvaneshwari, Assistant Professor, PG and Research Department of Business Administration, JJ College of Arts and Science, Autonomous, Pudukkottai. The content of Accounting for Managers, Introduction, Meaning of Accounting, Definition of Accounting, Scope of Accounting, Basic Accounting Concepts, Accounting Conventions, Objectives of Accounting, Accounting Transactions. Meaning of accounting. Accounting is used as the language of business. Accounting involves the procedures of recording the financial transactions in the books of accounts, which are helpful to its users for analyzing and interpreting the financial soundness of business. Definition. According to American Accounting Association, AAA, accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Scope of accounting: business forecasting, correct taxation, proper decision making, documentary evidence, performance of business. Number 1. Business forecasting. A business entity is interested in ascertaining its future level of business on the basis of its past as well as present level of business activities. Such forecasting enables it to chalk out strategies like expansion, diversification, etc. in advance relating to future plans with regard to the level of existing activities. For example, if a manufacturing unit engaged in the manufacturing of sports shoes want to go to ahead for expansion of diversification of its to go activities into manufacturing of formal shoes, the accounting may prove to be extremely helpful for taking appropriate forecasting decision. Correct taxation. A company has to fulfill its obligations with regard to liabilities on account of various government taxes. Example: service tax, income tax, sales tax, excise duty, customs, etc. The amount of such taxes is decided on the basis of financial results reflected through financial records. An appropriate accounting system prevailing in the company facilitates determination of accurate amount of each category of tax. Proper decision making. Proper decision making. A company is frequently required to take important decisions regarding: Number 1. Fixing the prices of finished goods on the basis of their cost. Number 2. Investment level in new projects. Number 3. Increase in salary and wages of its employees and laborers. Number 4. Distribution of evidence and dividends, bonus, etc. Such decisions need to be taken very carefully, as any wrong decisions may land the company into financial trouble, coming out of which may not be that easy. An efficient and effective accounting system of the company may be immense help in taking crucial decisions by the management. Documentary evidence. Records maintained through accounting have the legal sanctity too. They can be produced as a proof in the court of law to verify the necessary business claims. As the records of business transactions are based on documentary evidence, and each and every entry is supported by the authentic vouchers. They are accepted by the court of law as an evidence. Analyzing the performance of the business. Maintenance of a proper record of every business transaction through accounting enables one to ascertain the performance of a company in terms of income, expenditure, profitability, etc. in detail. Analysis of various subhead items can also be carried out and necessary steps may be taken to improve the performance of a company. Basic accounting concepts. There are so many accounting concepts. We take only 8 concepts. Business entity concept, going concern concept, money measurement concept, dual aspect concept, accounting period concept, cost concept, realization concept, matching concept. Business entity concept. A business entity is an organization of persons to accomplish an economic goal. According to the entity concept, the entity that represents the association of persons is considered the distinct and separate from the owners, managers, and employees of the enterprise. The accounting entity may be the business unit itself. Maybe it's a sole proprietorship, partnership firm, joint stock company, cooperative societies, or a government enterprise. A defined part of business or an department, an amalgamation of related business, for example, a holding company, depending on the user's need. It can be a non-business group like a club, religious body, which engages in economic entities. The entity concept delimits the area to be covered by the accounting records and reports. It determines what is to be recorded and what is to be excluded from the books of accounts. Going concern concept. According to International Accounting Standard, the enterprise is normally viewed as a going concern, that is, as continuing in operation for the foreseeable future. It is assumed that the enterprise has neither the intention nor the necessity of a liquidation. This concept assumes that a business entity has continuity of life. It will continue for an indefinite period of time. It has no need to intention to close down. This concept is important for valuation of assets and liabilities. It recognizes the value of assets and liabilities of the business enterprise on the basis of their productivity and not on the basis of their current realizable value. Many assets derive their value from employment in the firm. If the firm chooses to operate, their realizable values may be a fraction of their book values or their value for the firm in generation of income. For example, approach roads laid to connect a factory with a highway will be worthless when a factory is closed down. Money measurement concept. All business transactions are measured, expressed, and recorded in terms of money. Money provides a common denominator or unit of measurement by means of which facts about the business can be expressed in terms of quantities, which can be added or subtracted and summarized. Money as a common denominator helps to quantify the diverse range of data to enable the determination of profit or loss financial position. The rupees is a common unit of measurement for economic events and transactions in India since it is a legal tender used as a medium of exchange. Dual aspect concept. Every business transaction recorded in the books of accounts of a business has two aspects: receiving of benefit and giving of benefit. Both the aspects of each transaction must be recorded in appropriate accounts of the business. Capital plus liabilities is equal to assets. Capital is equal to assets minus liabilities. Accounting period concept. A business unit may continue for an indefinite period. It is possible to ascertain overall profit or loss of the business when it is liquidated. Cost concept. Accounting is a historical record of transaction of a business entity. According to the cost concept, assets are recorded at the price paid to acquire them. This cost is the basis for all subsequent accounting for the assets. The assets are gradually depreciated on the basis of cost and effective life of the asset. Realization concept. Revenue is the gross inflow of cash, receivables, or other consideration arising in the course of an enterprise from the sale of goods, services, and from holding of assets. According to the realization concept, revenue is considered as an earned on the date when it is realized. The term realization implies the legal liability to pay the buyer or user or customer. Matching concept. The primary objective of commercial enterprises is profit making. The accountants are responsible to match the revenues earned during the accounting period with the cost associated with the period to ascertain the profit earned. Matching of revenues and cost relevant to a specific period is called the matching concept. Accounting conventions. Convention of full disclosure, convention of consistency, convention of materiality, convention of convertism. Convention of full disclosure. According to this convention, all accounting statements should be prepared honestly. This should be evident through the transparency of the statements. A statement should disclose fully all the significant information, facts, figures, and the details which are material interest to the owners, investors, creditors, etc. Convention of consistency. The basic aim of the doctrine of consistency is to preserve the comparability and reliability of business statements. According to this convention, the rules, practices, and concepts used in accounting should be continuously observed and applied year after year. Comparison of results among the different accounting periods can be significant and meaningful only when the consistent practices were followed in the ascertaining them. Convention of materiality. Materiality means relative importance. All important items and facts should be disclosed in accounting statements. Unimportant and immaterial details need not to be separately given. Otherwise, the accountant becomes overburdened with the unnecessary details. Convention of conservatism. Conservatism is a policy of caution or playing safe. It demands taking gloomily view of situation. Conservatism is a defensive accounting mechanism against uncertainty. Objectives of accounting. Maintenance of accounting records, ascertainment of profit or loss, providing information. Maintenance of accounting records. Accounting records are the basis of the accounting work. The records have to be maintained systematically. While maintaining the accounting records, the generally accepted accounting convention and concepts. Ascertainment of profit and loss. Accounting is expected to ascertain and reveal the results of the operations of a business. Providing information. Providing information has become the most important objective of accounting. Making decisions concerning of limited resources, including identification of crucial decisions. Effectively directing the controlling of an organization's human and material resources. Maintaining and reporting on the custodianship of resources. Facilitating social functions and control. Methods of accounting. Basically, all the methods of accounting classified under the two headings: single entry system, double entry system. The term single entry is used to define the method of maintaining accounts which do not conform the strict principles of double entry. Double entry system. This system was invented by an Italian and it is spread all over the world, becoming a very popular. Every transaction has two aspects. One is benefit receiving aspect, incoming aspect. Accounting transactions. The accounts may be classified into three categories. These are personal account, real account, nominal account. The personal account is an account to person which may be natural or artificial or representative group of person is referred a personal account. Real account is relating to properties or assets are known as the real account. A separate account is maintained for each asset. For example, cash, inventory, plant, machinery, land, building is an example. And nominal account. Nominal account is the income, expenses, gains and losses are known as a nominal account. These accounts are known as the fictitious accounts. They do not represent any tangible asset. A separate account is maintained for each head or expenses or losses and gains or income. For example, wage account, rent account, commission account, interest received accounts. These are some examples of nominal account. Okay, preparation of journal. Journal is a book of recording transactions and when they occur. Recording of the transaction is called journal entry. Ledger. Ledger is defined as an accounting book where is all the transactions are recorded in summarized and classified manner. It is the most important books of accounts. It may be maintained either from a form of physical book into which credits and debits are posted or accounting computer program wherein the various credits or debits entered. Trial balance. Trial balance is a statement in which the balances of the ledgers are compiled into a debit and credit columns. A company prepares a trial balance periodically, usually at the end of every reporting period. All the accounting entries are recorded accurately and all the ledger balance are correctly extracted. Thank you so much for watching.